American University in Bulgaria.
It's the second lecture of those 3 nights event. So tonight we're going to talk about growth and venture capital, and you are going to participate in the second part in an exercise that Professor Harris prepared for you. Please help me welcome Professor Harris for this tonight's show.
Okay, so welcome, late lecturers here. How many were here yesterday? Okay, but there are some that weren't here yesterday, and Vinita asked me to cover very briefly just one piece so that we're all on the same base before we go into the growth capital. So the question is, what is innovation? And many people have different definitions for innovation that really confuse if you don't have one which you agree upon. And so we start off and take a look and say innovation starts with an invention. So an idea that has been executed, that has been created. Before the invention, you have the idea, but an invention is something that's actually, you have a prototype or something that almost proof of concept. And that invention you're trying to take to a market. So the second component is the market. That could be a new market, that could be an existing market, a niche market, many different types of markets. And you're trying to take it there. And to do that, you need a process. You need a process that basically takes that invention to the market. So we talk about innovation being an invention paired with a process and a market. And that process that we're talking about is entrepreneurship. So if we're talking about innovation management, then we're talking about managing the abundance of inventions. So the R&D we're trying to get going stronger, and also trying to utilize the ones that are happening as well. So technology transfer from universities, etc. And we're trying to get those to markets. If it's a new idea, it might be a new market. We could be addressing, though, existing markets, trying to compete with people that are already there. And the managing the process is really what's the entrepreneurship, the entrepreneurial talent that we're trying to create. Because the markets are there, the innovation's there, but how do we get there? That's the path is entrepreneurship. Just so that we're all on one base. We have examples where we have a lot of this is blinking red, but we'll see. We have a lot of inventors for the light bulb, okay? A lot of R&D, a lot of research done to invent the light bulb. But if you ask yourselves, usually you say, well, that was Thomas Edison that invented the light bulb. Thomas Edison was one that took it to the market, created a market for it, and started to sell. Okay? So, we can look at all of these with asterisks here. They had patents. Okay? So patents don't always protect your products either, because, to be honest, the patent lawyers very often don't know what you're really trying to protect. And because they're not the technologist, they put wording in place that is maybe not defendable. That's why we have, in the corporate environment, very often you'll see, okay, someone's infringing someone else's patents. No one does that intentionally. And what usually happens is that you then get together, the two companies that are basically saying, and you agree with cross-licensing that you can have their technology and they can have our technology, and maybe you decide in some places on some royalties, but usually you don't litigate to the end because it's just, no one knows really whether you can win because it depends on the wording of the patent lawyer. Okay? Now, you still do try to protect IP, intellectual property, with patents. But it's not always, in a commercial environment, it's not always easy to be able to make sure that you can defend it. Okay? So here, 40 years, almost 40, 39 years before Edison brought the same technology, carbon and vacuum, it was already invented, but it didn't go to the market. Okay, so if you look at this list and you want to become an entrepreneur, you don't want to be the one somewhere in the top of that list. You want to be the one at the bottom of the list that gets all of the credit and fame for creating and bringing that to the market. Computer, you can do the same. You can basically take any invention today, any innovation today, Google it, and find hundreds of inventors that were in the life cycle of that invention. And you could put a chart together like the light bulb Hall of Fame. Okay. And then you need to define what does it mean. In the computer, everybody wanted to be the owner of the computer. The first one using a RAM, the first one using a solid state, first one being mechanical. Okay, there's here, 1822, Charles Babbage. He's known in math and in the algorithm area, but his was never completed. It was actually completed in 1991, part of it, and 2000 in the museum. Okay, the museum tried to complete it. It just never got done in his lifetime. Okay, so couldn't also go to the market because of that, and it was a mechanical one. Okay, there was no circuitry yet, but you can go and talk about that. So, just so we're on the same base, invention, market, process to get there is entrepreneurship. Okay. So, now we're going to venture and growth capital. What's this? How much is this worth? Huh? $1? $1 and some? In euros? No. Okay, what's this worth?
1 can of Dr. Pepper?
Nothing. Nothing.
Yeah, here's nothing. What's this worth? I mean, this is at least paper. In Romania, it's plastic. If you've been to Romania, the two lei are plastic. This is worth nothing. Yes?
Depends on what the bank says.
No.
We give it back.
With hyperinflation, the bank doesn't take this either. Okay? So, why do you say this is worth a Dr. Pepper or?
Because this is our agreement, we make it worth it.
An agreement?
Yeah, it's like a means of exchange that we do.
So, I make an agreement with the store that forever I'm going to get a Dr. Pepper for 2 leva? No?
Well, the rate is like nationally focused.
The exchange rates are not. You don't have any inflation here? No? No? Very low. Huh? Okay, but you do have inflation. Okay, so the value of, or what you get for this changes slightly.
A lot.
A lot. Depends, I guess, whether it's shoes or Dr. Pepper. Okay. Okay. So, why does this work? Why can I go down to the store and get a Dr. Pepper for this?
Because they do value the value.
Because it's money. It's the government. This is fiat money.
And you believe the government?
Well, since it's fiat money, if you want to pay with sticks and stones, it's up to you.
Yeah. That's the way we used to, you know,
Exactly.
thousands of years ago.
But it's,
And why did we believe that?
well, we drop the stones because if you want to buy a car, for example, you have to bring like 3 trucks of stones. It's not really fun to carry them around.
So you have to buy a truck first. Okay, so the reason that we can buy something with this piece of paper, I mean, with the coins, you could argue maybe there's some value in the metals in the coins, but this is probably, you know, not worth the paper it's printed on. Why? Because we have a trust ecosystem that's working. Trust. I trust that when I go down to the store, I can get the Dr. Pepper for 2 leva. Does it cost 2 exactly, or?
180.
180, okay. So in 2 weeks it'll be 2. So I can go down the store and get that. And the shop?
It's the same for the shop.
The shop goes and buys the Dr. Pepper for 150, or probably 50, from, you know, someone else. And that buys it from the dealership, and that buys it from, you know, so everyone trusts that they're going to get, you know, value when this passes around. Okay? It's trust. And when we're talking about venture, and especially growth capital, we're talking about trust. We'll also be talking when you, as teams, want to go after venture capital, you have to create a trust relationship with the venture capital side. They will fund an idea not because the business plan has great 4-color graphics on it. They will fund it because of the team that's there and that is capable of articulating their idea, showing their passion. And they create a trust relationship. And with that trust relationship, they get money. Okay? So we'll start off with that. Trust is probably the biggest part here to understand. And if you ask questions when we go through this, because some of this, especially for the techies, this is hard. You should probably deal with this better. But if you're questioning, not following it, just think back trust. Oh, then you probably get the gist of what we're talking about here. Okay? 180. Dr. Pepper. Okay. So, if we're looking at, and this is a cash flow diagram again, we have so many of those when we're teaching this. Typical startup is spending more than it's earning, and that's why it goes into the negative cash flow over time. Okay? And we're hoping to get here and then have a positive cash flow. I'll just keep going, okay? But it is hard to recognize. So we're using a model here. So I'm using $1 and $8 and $20. So it's just a model, okay? In if we're going after seed funding, for example, we would start with $1 here. And then after a while, we have a number of venture capital rounds. And that's an $8. And we start getting sales, and we can get another capital round with $20, another with $40, and then we do an IPO. Everybody know what an IPO is? Initial public offering. So we go to the stock market to get capital. The thing that Facebook probably shouldn't have done, okay? You know, at least, yeah, disputable, at least at that price. So we have a number of rounds here. And I was talking about trust. How do we get from 1 to 8 to 20 to 40 to 80? How do we get there? It still says 2 on this one. It didn't go from 2 to 8 to 20 while we're talking. You know, you need somehow to build trust so that you can get more capital. Okay, let's keep on going. So what we're trying to do is create value over time. And this is a step function. We have the different rounds, you know, the $1, the $8. I'll just keep going. Listen. 20, 40, 80. Okay? So, and it's a step function of creating value as you go forwards. Okay? So, after that initial seed funding, you're talking about venture capital. How do you tell them, well, I actually need $8 now. I need those $8. And they're going to say, well, where's the value that you've brought into the company that can justify me giving you 8 now versus the 1 that we just had? And then the 20 and the 40 and the 80. We need to look at what have I created on value in the technology, in the product, in the marketing, and in the management. These are the 3 vectors we look at for creating value. Okay. So if we're looking at the technology, at the very beginning we have a concept, and then we move on and we have a feasibility or a prototype so we can actually show that this thing works. We have a patent application. Okay, just spoke about patents. Working prototype. This is really a cool thing. A manufacturing prototype means it not only works, but I can actually manufacture it at a cost that I can earn some money with. You have if it's like a telecoms product, you need regulatory approvals. Those are valuable because you can show, well, now I can't just manufacture it. It works. I can't just manufacture it, but I can also take it to the market legally. Okay? And then market introduction. So I've actually brought it to the market. Okay? For a venture capitalist, they're looking and saying, well, these are improving this company, the way they're moving forwards, being entrepreneurs, getting this invention to the market. This is part of the process, the entrepreneurship process that we're talking about. If we look at the market value, again, same idea. We've had a market analysis, we've done some research, focus groups, some surveys, we have some reports published, so we're bringing that news out into the market. We have a beta test with customers, a market launch. We have customers that are satisfied and giving us good reviews. And we have a backlog. What's a backlog? Do you know what? Backlog is when you have more orders than you can sell. Okay? So that's what you would really like to have. This is basically saying, I have more customers than I can service with today's production. If I have 3 months backlog, means if I quit selling, the company quit, going after customers, I can still sell to customers for 3 months. They want the product. Great thing to have, backlog. And then you do the same on the management side. You have a CTO, chief technologist, president, getting a marketing VP, controlling, manufacturing vice president, etc. You basically start filling, and we spoke yesterday about the company building, that fourth part. That's where you kind of fill these good high-level positions. You start splitting the company up into silos. You don't want a company to work like a silo, but you do need a division of labor. And if we take a look at that, we spoke, these 4 areas, we have the cash flow diagram, then we can basically look at each of these as it goes forwards. Concept, early validation, market traction, scale validated, predictable scale. And that's how we can get the funding that we need. Seed, Series A, B, Series N, and the IPO. Okay. That's why we stick to the same diagrams, because we can show what's happening in these different timing periods, what needs to happen. Venture capital, investment capital for entrepreneurial ventures tend to clump. Clump is kind of a US jargon, bigger pieces, okay? If you're putting the chocolate powder into your milk and you didn't do it quickly, then it clumps. Okay. So very often you see venture capital more in certain regions. You see it in different industries, okay? So pharmaceutical has huge venture capital because they need to fund something that's going to need funding for 5, 10, 15 years until the product actually gets to the market. It's important to encourage local investment in entrepreneurial ventures. We spoke yesterday about why it's hard to get venture capital into countries. It's a function of the profit capabilities that you can actually get in a country. Not even in a region, but in a country, because of legislation. And you can take a look. I won't go into details of these. You'll have these slides available. But you can basically here split out Europe, which is that little piece, against North America, which is that piece. And you see that, we don't have, even though the geographies are about the same size, in population we have more, but in GDP, we have a lot less capital for ventures. And then you can take a look at it from the different countries. There's also interesting splits there. And this was what I spoke about yesterday, the inventions, that Europe has actually more inventions, a lot more inventions than the US. But we're great in inventing. And since software can't be invented, it would be even more than this discrepancy. We're great in inventing, a lot of engineering capacity in most of the countries. But we're not good at all at taking these inventions to the market. Okay? Because being 65% more than the US doesn't give us the advantage that we need. So what we need more inventions anyway. So if we spoke about innovation management, we had the invention, we had the process and the market. We need to work on all three. So we need both quantity and quality on each of those. But where we're really bad at is taking those to the market. We're missing those entrepreneurs that pick up that invention look for the market and take it there, bring it there. And that's why we're doing a lot of courses like this, education like this, also to hopefully get some of you motivated to become entrepreneurs, to take this to the next step. Okay. Always have the... So if you're looking at, this trust area, and you take a look at how a VC looks at a company and how you look at a company, you will sometimes have discrepancies in between. And the VCs and angels as well have ways of looking at the company and trying to rate them. We'll be doing in the second half, we'll be doing an exercise here. That'll be looking a little bit at this. Growth capital. Growth capital. When you're starting a company, the two leva, and you have 3 founders, A, B, and C. Each have put $1,000 on the table and own a third of the company, but we defined basically when we created the company that these $1,000 were worth 1 million pieces of stock. Meaning that a piece of stock is 0.001 cent per share. You find that very often, that it starts at a very, very small piece. It doesn't start at $1. It starts a very, very small piece because you want it to grow over time. So, I'm an entrepreneur. I own a third of a company. It's worth $1,000. That's already a good start. Okay? My part is worth $1,000. That's what I put in. We want to hire a chief executive officer to attract someone that is experienced. They will see and want the company to grow. And so they want to be part of the growth. And so a CEO is looking not necessarily at a base pay. Of course, they need to pay their bills each month, but their motivation is to get equity into the company and that equity to grow. Okay? So you attract an executive like that by giving them 1 million shares, but you tell them, yeah, it's going to cost you 1 cent per share to be able to buy that. Okay? So the president buys at 1 million stock, so it's kind of equal to the founders, at $10,000. What happened here?
We earned $9,000.
Yes, we are. Because we could sell our stock to someone at 1 cent per stock. So our stock is also now 1 cent per stock. Okay? Follow that? This is where we're creating value. Now, what I didn't say earlier, when you start, there's only 2 points in the time of a company that you can measure its real value. That's when you start it, count the number of tables and laptops and whatever that you're putting in it. Here, the $3,000. And when you do an exit. Doing an exit, 3 possibilities. You sell it, you do an IPO, or you go bankrupt. That's the exit you don't want to do. But those are the only 2 points. Start and exit. Everything in between is virtual. And because that's virtual in between, you need to articulate it. You need to be able to articulate it. You're going to a venture capitalist and you're asking them to fund. We saw the different vectors, how we articulate that. Technology, market, people. Here, we're basically at the same time also creating that value by being able to show the value of the company also to external people. It's still virtual value because we haven't sold we sold that stock to this president, but usually you have limitations. You can't sell it immediately to externals. You have a couple of years where you're not allowed to sell, et cetera, et cetera. So it's a virtual value. So I had $1,000 and I had 33%. Now I have $10,000 and 20% of the company. So my stake in the company is going down, but the value is going up. And this is typically very difficult, because we're going to go on a couple more times here, very difficult for founders to realize, well, I'm losing my equity, I'm losing my say in the company. Yeah, but they're getting rich at the same time. That's what, you need to balance the understanding between giving up, and you don't give equity away easily. You negotiate hard to keep as much equity as possible. But giving equity is a way also to earn money or create value. So here we're bringing venture capital financing into play, and we're selling at $1 per share. 5 million stock. So all of a sudden, there's someone that has 50% of the company, has $5 million invested here. My piece is now only 10% of the company, but it's worth $1 million. If I can exit with that. Okay? If I can exit with that. Then we go the next round, $10 million, Series B. So we're holding this back for additional investments. Another $10 million here. Now these two together have 33, each 33%. My piece is only 6.7%, but it's worth $2 million. So from round to round, we've been able to articulate additional value and sell this to the venture capitalists, because they're purchasing. They're saying, I'll give you the money against equity. And the equity is they buy stock in the company. And then we do an IPO. And here we're looking at coming out with 15 million shares at a value of $10 per share. And then you have public IPO, $50 million. So I now have $10 million as one of the founders. The company is a $180 million company. This has to work, though. This is where it didn't work with Facebook, okay? They thought that they had, what was the initial price, $38 or something like that? They thought it was worth $38. People bought at 38, but then people lost trust, lost that belief, and it went down. Billions gone. If you can get this to go and be stable on the market, then your company is this much value. Here with an IPO, you've pretty much approach the exit. There's limitations for founders on, typically you set it up that way, so that founders cannot immediately sell. So if you can keep that stable, this is your exit price. And at some point in time, you can start to sell off and get your $10 million back. Looks easy, right? From $1,000 to a $10 million company. No, it's hard work. A lot of articulation. Work besides that, but also articulating how the value has grown in that time. And so if we take a look at what we've done here in the same graphs, we're here. And then we've taken this piece. Here we were a third. Here we're a fifth. Here 10%, a tenth. And at the end, 5.6%. Which means that everyone else has probably more to say in the company now than you do. And that's a decision you need to take, whether you want to go that growth path. If you need money to produce, you have to, because you need capital to be able to manufacture and produce. Sometimes you might want to say, okay, no, I don't want to give up too much equity because the founding partners should be able to still decide what the company's doing. But that might, and probably will, limit your growth. But it's your decision as an entrepreneur. How far do I go with that? Interesting thing is the paradox of power is there. Basically, at the beginning, you have the most freedom, and then it kind of disappears. And you start to get a little bit back when the company really grows, because then the value of your stock is growing as well. Not the percentage, but the value. This is kind of the control tipping point. Here it goes away, and here it kind of comes back a bit. Opportunity recognition. How to evaluate. There are founders' issues. So as a founder of the company, there are employee issues to look at. Corporate issues. Do I have sufficient capital? Do I have that freedom of operation? When you start off, you just decide. Probably the three that started off, just each of them decide. And it's probably okay at that point in time for the others. They're usually aligned pretty well very early on. But then later on, you need to go to a board, talk to, all of the people that have a stake in the company, and get buy-in to do a decision that you used to just do like that. Those are things to think about when you go down that path. Previous investor and creditor issues. If you're doing, you get seed funding from a business angel and take some equity, and you want a round A, so venture capital funding. It could be that those are not compatible, those two. The seed funding doesn't want to give up their shares, and the venture capitalist wants more of that equity. So you can get into situations where if you don't have the same VC, or it's not going to be an angel all the way through, but the investor, I'll use the word investor. If you don't use the same investor throughout you get kind of a fragmentation of your financing, which is hard to get rid of then, because no one wants to invest if they're not going to be able to get enough equity out of it. And it might be incompatible competition. Okay. Etc. Is there a potential for adequate return? Is something that the investors look for? So in the IT world, you're looking for something like 10x return in 5 years. So if I invest $1 million, then I want in 5 years 10 million back. Okay. Pharmaceutical, it's different. You're investing higher numbers, and then you get your return in a longer term period back. So different markets, different needs. In the IT area, they are assuming that you're going to only get a home run in 1 out of 5, 1 out of 10 projects that you start. So 4 out of 5 or 9 out of 10 are failures, or not a really high scalable, not a home run. You know the terminology home run? Okay. Baseball. So when they're looking at that, they're basically writing off a number of ventures. In pharmaceutical, because of the level of investment, they have to have almost 1 out of 1 or 1 out of 2 successes because of the level of investment. And that's why they go after patents. That's why they really try to make sure with the marketing that they have that in the market. Different worlds, different technologies, different needs because of those. Opportunity for a home run. They look at that. No, this looks like something that could really take off. So the motivation to invest there is maybe higher because they might have a couple already in their pocket that aren't doing so well. There might be a motivation for them, if they see one that looks really promising, to go after that one. Potential fatal flaws. What's a fatal flaw? What's a flaw? A flaw would be, for example, I want to sell Dr. Pepper for $180, and it cost me $3.90 to produce it. I didn't know that when I put my business plan together. I thought it was going to be 50 cents. And so I go off with my business plan and start executing to the business plan, and everybody believes it at the beginning, but something comes up and it becomes $3.80. It's a flaw. That's even a fatal flaw, because that basically stops the whole possibility. If I can't reduce the price to where I can sell it, the company won't work. Okay? So that's what we look for, fatal flaws. And there's going to be flaws here and flaws there. The business plans that we put together are always too optimistic. Whatever you do, they're always too optimistic. Okay. Time requirements. How long is it going to take to get to the market? And this happens in corporations as well. Anybody remember the Pentium 4? No, you're too young. No. Pentium 4, okay? The Pentium 4 was a great product, but at that time, or before that time, Intel would keep all of its IP very close. So all of the new instructions that could deliver performance, secret. All of the new software that could help deliver performance, secret. Announce the product. Takes 18 months for the software world to utilize the new features. And so you basically can't really sell product. You can't ramp a product for 18 months until the software industry comes and catches up to be able to do that. Okay? So it's not just about a feature. Intel, recognizing that after the Pentium 4 start, turned around the way it worked with ISVs, with independent software vendors, and started giving them 2 years in advance already simulators for the instructions. 18 months in advance, already early hardware, all under non-disclosure. So they couldn't talk about it, no reviews, no performance reviews, because they were not performant. They were functional, but they were not performant. Okay. And the software world could start to develop the products in parallel while the CPU was still being finalized. Okay? A processor takes about 4 years to design and produce. And so after about 2 years, all of the features are kind of fixed, and you can start with simulators. You know kind of what the instructions, new instructions or new functions should be doing, at what clock speed they should be performing, et cetera, et cetera. You can start giving that, and then the software people can start thinking, well, what would I do with that? And then they can start rewriting their code. And they installed a whole software group that would help those software companies get their software very performant, so that on the day of the announcement, you had a whole palette of applications that would work with your product line. Okay? So just the concept of trying to protect certain IP too long, almost, it had a very severe impact on the revenues. The Pentium 4 just took too long for it to ramp. And now the people within Intel are not looking at, the launch date. They're looking at the ramp speed. And each processor generation, they're trying to ramp faster than the previous one. Time to money. So the investment you do for 4 years, you're trying to get back as quickly as possible. So that was a time period that the competition also could catch up, because we had no differentiation. We had features, but no differentiation. There was no software out there that was helping differentiate ourselves from the competition. Okay? So, time requirements that you look at. Development time requirements, time to market. And then you might need to approach the market like this, differently, to be able to, simultaneously, in parallel, change, hardcore rules within the company about what can be disclosed and what not. Okay. And what that would have for potential damage, etc. So that was a big step for Intel to change that, just a mindset change. Protecting everything versus opening up to a certain level to the software world, which was kind of seen as a sieve, it would still go out to the market. Okay. Follow-on investments required. So investor will be looking and saying, well, show me your whole requirements. We're not talking today about investing the 20 million, but we're talking about the 8 million. But show me the 8, show me the 20, show me the 40, show me your plans so that I can think about, we need to do this in a step function. We're partners. Venture capitalists are partners in your endeavor. They want to do this step by step. Interested that your products will succeed, but they also want to finance it only as you achieve your goals. Portfolio and fund compatibility. I spoke a little bit about that. If you have fragmentation, that could be an issue. You might want to defrag your finance, etc. And here we have, how are we doing on time?
We have about 10 minutes.
About 10 minutes, okay.
And we are having a break.
Okay. Because right after this, we're going to go into the exercise. So I'll open for questions from this first. Yeah? Okay. So for this first piece, any questions? I'll start asking otherwise. Come on. Yes?
So you're saying basically the people that who start up a company have to somewhat increase their profits by not compromising, but making their share of the company smaller. But is there a way to have venture capitalists buy, share in the company, but not have a vote in what the company is doing to sort of remain the sole deciders?
There are silent investors, but it's more rare, okay? Because people, if you're giving away money and something's, in the company, this is the logic. If something starts to go wrong, then I want to have some instrument of being able to help, maybe change, some voice in that. So that's why, you're basically equity. And they will also want to earn, okay? So you could have equity without voting rights, but then they're a little bit, can I really trust them? What happens if it starts going in the wrong direction? I don't have any control mechanism to work there. Depending on what business you're in, you have to go after more funding early on, and in some cases you don't. Okay? So if you compare, we did this yesterday, just as a brief, if you compare Intel and Microsoft, Intel had to go after the stock market, do an IPO very early on, because they needed manufacturing capability to produce that. And that cost, at the time it was about $1 billion, now it's about $10 billion per factory. You need that level of capital, you have to go to the public market. You're not going to be finding that in one investor giving you $1 billion. Okay, so you have to find that market spread. But what that means is that you've already lost, the founders have lost equity in comparison. Okay, so if you look at the Intel founders and Bill Gates, Bill Gates is much richer because all he needed was a floppy disk replicator at the early stage, which cost $100,000. And with that, he could build billions of revenue. Didn't need to do that investment. And his shares, he kept lots of his shares very, very long because of that.
If you're going to a public, if you're in the stocks, shareholders don't even have a say in what company does most of the time, right?
If it's very broadly distributed after an IPO, that's ideally what you would want, Okay, because we're doing, we said exit, three exits. Let's not think of the third one. Going broke, sell, or stock market. Okay, if you go to the stock market, selling for some reason wasn't an option. You needed either more capital or you thought you could earn more money going to the stock market. Okay, so if selling wasn't an option, you actually want the stock to be distributed widely, because otherwise someone can come back and buy it. Okay. There's a lot of strategies on the price of a piece of stock. Okay, so Intel was always looking at a piece of stock to be under $100, because there's a lot of sales packages, technology packages that you buy that has one piece of Apple, okay, that's already $500. One piece of Google, 3 pieces of Yahoo, a couple of pieces of Intel because it's, and Microsoft, so you have a technology package you buy for a certain amount of money. And if you're high, that's what Apple has at this. Very often they're left out of these technology packages because it gets too expensive for the broad mass to go and buy. But if you get your stock distributed to the broad mass, it's very difficult for someone else to come in and try to buy you. Very difficult. That explain a little bit? Okay. There was one up here somewhere. Excuse me?
You already spoke about it.
I already spoke about it. Okay.
And like people getting new stock in the companies, they can keep the decision-making power.
Okay. Yeah.
Where to look for venture capital in Europe?
Where to look for them? Yeah. Under the rug.
Great idea. Like, how do you start?
Well, there are actually quite a number of what you need to do, and maybe I can delay my answer until after our exercise, because part of that exercise is something I'd like you to learn as well in that. Okay, so after the next session, get back to me with the question. Okay. Any more questions?
I don't see any hands, so maybe we have still about 5 minutes.
Mm-hmm.
I really would like to share your experience as an entrepreneur in your own venture in those 5 minutes for students here.
Okay. How many picked up? I have brochures here. How many picked up a brochure? How many didn't? Okay, there are brochures here. I retired from Intel last year, September last year. Okay, we're a number. I'm getting into the blinding point of that. A number of reasons. First of all, I had achieved at Intel a retirement age. Okay, kind of a weird rule, but there's a rule of 75. So if your age and your service years add up to 75, you can retire, which means you can take your unvested stock with you, you get a pension plan, et cetera, et cetera. I've had that for a number of years. I wasn't really looking at that. And if you look into the brochure, you see kind of a product pipeline. I used that methodology on the very first page. And the yellow part is as far as Intel could go. Education, which is great, still needs to be done. But it doesn't help the new ventures get to the purple area, which is on the right, and basically drop them off on the yellow, and in between there was nothing, and we were trying to get more and more companies on the right side. And so with that motivation with the pension plan, et cetera, et cetera, et cetera, I decided to do that piece in between myself. Okay, so I created InnovaVentures, which is a global enabler, trying to enable new ventures, and put services in place that can help the new ventures move from the left to the right. Okay, from very early startup, advisory functions, all the way to heavy lifting market access. We have one service that's called Get Traction. That's a 3-month US program, being in the US, to actually get customers, get established, market there, and basically get access to the US market. And that's not, you find that Get Traction there. Okay, so put that together as a program to help new ventures move through that pipeline. Okay, and each of those services are described here. Okay, front and back. There's actually even more. You can go to the website, but these are kind of the ones that are pretty much necessary there. The Deep Dive and Get Traction, they are both very US focused, trying to get access to the US market. And we showed yesterday for European, the first step is US market and then global. Okay, so that's why. For the other markets, there's something that we call the network of clusters of innovation. So through my 10 years activity at Intel in new venture creation, I have a big and broad network. And so if you want to go to South America, we have connections in Brazil. If you want to go to Asia, our stepping stone is Singapore, because they understand the West a little bit better and can also understand how to get into China a little bit better. Going straight is hard, very hard. Okay, connections in Japan. Those are stepping stones. There we don't have as defined as for the US market, because that's usually the first step is going to the US. But we do have that opportunity to go to these through these different hubs. Clusters of innovation is what we call them. And in Europe, quite a few, as you can see on the matrix there. So a lot of networking. I have over 100 people, specialists, that are employed somewhere else, but are willing to invest some of their time as consultants, mentors for new ventures. So if your marketing plan isn't really clear, we can get a professional marketeer for you for 4 hours a week for 3 months to make sure your marketing plan gets moving. Or a professional salesperson that can look at your sales approach. Or a lawyer that can look at some of your legal paperwork. And the idea behind that is, okay, they need to be paid. It's a fair price. It's not over the border. But you don't have to employ them permanently, which young new ventures have a problem paying for. They need, if they get some funding, they need that money to finish the product and to pay their own salaries. Okay? So the idea is to make it lightweight, but be able to offer a lot of potential value to the new ventures. Okay. We have hubs coming into existence, incubators that typical incubator is offering space, a desk, telephone, networking. Okay? That's what I have at a hotel as well.
What do you get in return?
What they get in return? Sometimes they ask for equity, okay, for a desk.
No, what do you get?
What I get in return for this, either money or equity, okay? Okay, so I haven't found a way to print money legally. Okay. But we're looking, and you also see there's a seed fund as well. There's a real small line down there, seed funding. And so in the business model here, 80% of the profits go into seed fund. So basically, after you pay the bills, everything above that, 80% of that goes into the seed fund, some for other reserves. And that helps other new startups. So you can basically pay from the seed fund for some of the services that way. Okay. I've had my career. I want to have fun.
This program is brought to you by AUBGTalks. For more, please visit us at aubg.bg/talks.